2026 is shaping up to be a pivotal year for investors. Markets are evolving, AI is transforming industries, and opportunities for wealth creation are bigger than ever, but risk is real. In this video, I'll break down a strategic approach to investing in 2026, showing you how to spot trends, protect your capital, and build a portfolio that grows steadily. Watch closely. Your smartest financial moves start here. 1. Understand the new market landscape. The investment environment in 2026 is characterized by rapid technological advancement, evolving monetary policies, and shifting geopolitical dynamics. Artificial intelligence, blockchain, renewable energy, and space technologies are no longer niche areas. They are becoming integral drivers of global economic growth. Traditional markets, such as equities, bonds, and real estate, still play an essential role in a diversified portfolio. However, the key is understanding how these traditional assets interact with emerging opportunities. For instance, real estate investments now often consider technology-driven proptech solutions, smart homes, and sustainability regulations as part of their valuation. Bonds and fixed income products are increasingly influenced by central bank policies that respond to inflation and economic volatility in a hyper-connected global economy. A strategic investor in 2026 recognizes that markets are fluid and that the definition of risk has evolved. Technology can create exponential growth, but it can also disrupt established industries quickly. Therefore, analysis must combine traditional metrics with forward-looking innovation trends. 2. Prioritize knowledge and research. In the modern investment landscape, information is abundant, but insight is rare. A strategic investor dedicates time to understanding sectors, companies, and macroeconomic trends rather than blindly following trends. Investment research in 2026 often leverages AI and advanced data analytics. AI-powered platforms can process massive datasets, identify patterns in market behavior, and even simulate potential scenarios. This does not replace human judgment, but enhances it. Investors can now make informed decisions faster and more accurately, evaluating both traditional financial indicators and alternative data such as consumer behavior, supply chain trends, and global technological adoption. Thorough research includes analyzing company fundamentals, management quality, regulatory environment, competitive advantage, and market potential. It also includes assessing emerging sectors such as decentralized finance, AI-based automation platforms, and green energy solutions. Knowledge empowers investors to separate fleeting hype from sustainable opportunity. 3. Diversification across asset classes. Diversification remains the cornerstone of strategic investing in 2026. However, it has expanded beyond the traditional mix of stocks, bonds, and real estate. Modern diversification includes digital assets, alternative investments, and sector-specific funds. Equities continue to provide growth potential, but allocating capital to ETFs or index funds focused on high-growth sectors like AI, biotech, and clean energy can reduce the risk of picking single stocks. Fixed income and bonds provide stability and predictable cash flow. Real estate, both physical and digital, such as virtual land in the metaverse, can provide diversification and long-term appreciation. Alternative investments, including venture capital, startups, and tokenized assets, allow investors to access high-growth opportunities that were previously limited to institutional players. A strategic approach balances risk and reward, ensuring that no single investment or sector can disproportionately affect the overall portfolio. 4. Integrate technology and automation. Investing in 2026 cannot ignore technology. Automation, AI tools, and algorithmic analysis are transforming the way portfolios are managed. Investors can use AI-driven platforms to track market trends, optimize portfolio allocation, and even automate trades according to predefined risk parameters. Technology also enables micro-investing and fractional ownership of assets, allowing even smaller investors to diversify across high-value sectors that were previously inaccessible. Leveraging these tools strategically creates efficiency and reduces cognitive load, enabling investors to focus on long-term strategy instead of daily market noise. 5. Risk management as a core principle. every strategic investment plan in 2026 begins with risk management. High returns are tempting, but without a structured approach to risk, they can quickly erode capital. Risk management includes diversification, proper allocation, stop-loss strategies, and hedging through options, derivatives, or alternative assets. Investors must understand both systemic risks, such as geopolitical instability, inflation, or technological disruption, and idiosyncratic risks, such as company-specific failures or sector downturns. Strategic investing is about accepting calculated risk while mitigating exposure to catastrophic loss. This mindset ensures capital preservation even in volatile market conditions. 6. Focus on long-term growth. While being agile, while strategic investing emphasizes long-term growth, it also requires agility. Markets in 2026 move faster than ever due to global connectivity, AI-driven analysis, and rapid innovation. Investors must identify emerging opportunities early while maintaining a portfolio structure capable of weathering fluctuations. Portfolios are regularly evaluated, not daily micromanaged, allowing for the correction of overexposure or underperformance while maintaining long-term objectives. The ability to pivot when necessary without being reactionary separates strategic investors from speculative ones. 7. Embrace emerging trends. Responsibly, emerging sectors offer substantial upside but require careful evaluation. AI-driven automation, blockchain technology, renewable energy, and space exploration are all poised for exponential growth. Early adoption can result in significant gains, but over-concentration or speculative hype can be dangerous. Strategic investors conduct due diligence, evaluate scalability, regulatory landscape, and societal impact before committing capital. They often allocate a smaller percentage of their portfolio to high-risk, high-reward opportunities while maintaining a solid core of traditional assets for stability. 8. Tax efficiency and regulatory awareness. In 2026, tax strategies and regulatory compliance are critical components of strategic investing. Globalization and digital assets introduce complexities in reporting, taxation, and cross-border compliance. Investors must understand capital gain structures, investment accounts with tax advantages, and legal requirements for alternative assets such as cryptocurrencies or tokenized securities. Tax-efficient investing maximizes returns and ensures long-term sustainability. Strategic investors consult with professionals, leverage legal structures, and adopt compliant practices to minimize risk and maximize after-tax gains. Smart investing isn't about luck. It's about strategy, patience, and understanding market shifts. Apply these principles and you'll position yourself for long-term growth in 2026 and beyond. If this video added value, like it, subscribe for more high-level investing strategies and comment below your top investment goal this year. Let's make 2026 your most strategic year yet.